up today. So hopefully you all listened to us about roughly 2 weeks ago. Was it 2 weeks ago or the 4 week mark?
It was a month ago.
So 4 weeks ago we talked about a topic that's going to be very important to all of you all to hear. Before I tell you what it is, I want to let you know if you're thinking about joining Investing Education Academy, you can go to ianow.com, become a member. Also, Leon and I are looking for to increase our reach in the community in 2024 in regards to how we're serving the community, what activities that we're putting in place, and so we're going to start looking at doing more community-based activities. Some of you all have asked us, can we teach your kids things? Um, we can't teach your kids an entire lesson. However, we are thinking about putting something on a platform where we do host a kids event maybe once a quarter where kids at a certain age, we're still figuring out the details, are able to come in. We'll tell them a little bit about finance, but then on the flip side, they'll be able to ask us questions about what they believe the stock market is. Maybe real estate investing, we might get some of our partners to come in to provide information on topics that aren't 100% in Leon or I's wheelhouse. Now, with that being said, Leon, you want to tell them the topic today and why we chose it? I'll do a little bit of housekeeping.
Yeah, so like Brent said, a month ago we did a topic. It's called seasonality, and basically what it is we highlighted the best and worst months to be in the stock market and or invest in the stock market. And what we pointed out was that August and September are two, and this is, I can't remember how far. I think the data went back like 20 or 30 years. So 20 or 30 years worth of data, but August and September were the worst performing months for the stock market. Now, all of us who are invested right now know the last 2 months, August through today, the market has been terrible. Um, the S&P 500 is down 7%, and the Nasdaq, which is heavy in tech stocks, is down 7.5%. So a typical quote unquote correction in the market is when the market is down 10%. We're not there yet, but we're well on our way. I mean, we may get there, we may not. Who knows? But the point we were making when we did that podcast last month was to point out, to kind of give people a feel of when to get in, when to get out if you're playing that game, or when to get in at the best times. And right now, this month, so having said all that, September historically is the worst performing month in the stock market for the whole year, September. And we're seeing that right now, right? I mean, September's been terrible this month. Like I said, since August 1st, S&P 500 is down 7%, Nasdaq is down 7.5%. A lot of those losses have happened this month. So right now the market is acting typically as it does as it has throughout history, being that we're in the two worst months, right? So, but therein lies the opportunity, right? The market is down 7 to 7.5%, right? And history shows, great guy in history, the market generally, returns to a bull run and goes higher. We would say bottom left, upper right. So what does that mean? Right now we're in a trough in the market for the year. This is the best time. This is the best month, actually, historically speaking, to buy stocks. It's the worst performing month, historically speaking, and so far this year, I believe it's the worst performing month for this year as well.
Oh, Leon,
So,
let me jump in real quick.
mm-hmm, mm-hmm.
So for you all who are thinking like, okay, the market's down, that means it's probably going to keep going lower. That's not the way the market works. And it is a roller coaster ride. Leon said bottom left, upper right. But what I wanted to interject is it's bottom left, up, down, up, higher, a little bit, down, up, a little higher. And so it's a roller coaster ride up to the top right. But when you look at it overall, it is bottom left, top right. Historically speaking, that's been the market. Now, for those of you guys again who are in it and you came in during a dip, or maybe you got in right before it had one of those little roller coaster runs down and it's going to have the rise up. If you've ever been on a roller coaster, it goes down really fast. And when it starts cranking back up, it goes really slow. So the slow side of it is this. If the market goes down, let's say 5%, 7%, let's use what's going on right now, 7%. Some of you all who are not familiar with the market may think, why does it need 7% to get back to even? That's not actually the way it works. Normally, because you're going back to what's called a lower base, your lower base now, you might need 7.5 or 7.8 to actually get back to where you were before. And it seems mathematically incorrect to say that. But what happens is you lose the compounding effect of that money that was included, which oftentimes is not calculated when you look at the rise back up. You're working with a lower amount of money and you don't have the compounding effect. You missed a couple of days in there. And so that loss of compounding effect actually adds to either the number of days before you get back or the percent that you need to get back to where you were. So it's not apples for apples. And it seems like it should be. And then probably until you heard it explained like this today, you probably thought it was, but it's not. So for just, again, level set, when you're looking bottom left, upper right, and those dips in between, if you are on the bottom end of a dip, the percentage you need to get to the top is going to be higher than what it was to get you down. So just a note.
Yep. And to kind of drill home this point about why this is a particularly good time to buy, if you're looking to buy, I just did the math, looked at last year. So last year, September was literally the low in the market of last year. Literally low. Like seasonality, again, this seasonality doesn't always work. We're not saying this is do it every year. Nothing is absolute in anything. But typically, on average, it kind of does work, right? So last September through today, right now, the market is up 17%. And that was in September was the low of last year. So off that low last year through today, the S&P 500 is up 17%. Tech stocks, the NASDAQ is probably up 20-25% because tech stocks typically move faster. But our benchmark is typically the S&P 500. So just know that last year this worked. Now, I don't want to say this worked as in like this is some sort of scheme or some sort of system. It's not. I just want to make that clear.
Historical data.
Yes, this is historical. Like this is empirical historical facts that typically, on average, August, September are the worst months, are the worst performing months for the market, which in turn means for us as investors are the best times to buy. And I have an example. Last year, September was the low of the market. Since then, the market is up 17%. Now, what does that mean for right now? That means now, will the market be up 17% next year at this time? Who knows? It could be down 20%. We have no idea. But we're just using probabilities, which is what investing is all about. Probabilities say that right now, this point in time in the market is the best time to buy the market because over time, as Brent said, now he's exactly correct. The market goes like this. It doesn't go straight line. But the slope of the market is bottom left, upper right. There are, jiggers and jaggers all the way through. And right now we're in one of those trough periods. But this is a great, great, great opportunity to buy. Market is down, let's just say 7%. Will it go down lower this year? Possibly, who knows? But again, probabilities say now is the best time, is a better time to buy than when the market's on its high to get an outsized return.
Yeah. So with that being said, Leon, I think that wraps it for today for us.
Yeah. Just again, take this, as Brent said, the data, which we are, well, at least me, I'm a very, very big nerd for, and I invest on it. Take the data. Data doesn't lie, right? Numbers just don't lie. Again, as I said, September last year was the bottom for the year. It's up 17% from there. If you buy the bottom here, will it be up? Will it be down? Who knows? But probabilities say the likelihood of the market being higher next year this time are quite high. So if you're looking to buy, and don't buy anything, as we say, profitable companies with growing revenues, growing profits, and things that are in demand. But those profits and revenues growing profits and revenues is key. Oh, one other point. I posted this inside the community, membership community. But another big thing to look for. I posted basically the study, and it basically showed a bunch of assets, bonds, stocks, and commodities. And what it showed was, it was over 20 years. So over that 20 years, the best returning asset of those three are stocks. Now, here's the key though. The best performing asset within stocks are large cap stocks, because it also showed large cap versus small cap. Small cap is down a bit from large cap, but large cap stocks, and large cap is defined by anything over $10 billion in market cap. So anything over $10 billion in market cap over the last 20 years has outperformed every other asset. And also with that, with reduced risk. So very, very key. So when you're looking at growing profits, growing revenues, also look for companies that have market caps above $10 billion. Because again, probabilities say that gives you a better chance of investing success.
Yep. And when you guys do look at these investments, understand when markets are shooting up, like when it's definitely a full bull market going on, small sector stocks or small stocks seem very attractive. They have the fastest response to the market.
Yeah, they move. They're like meme stocks.
Yes. So in a bull market, they're fantastic, wonderful, right? Everybody's happy. But because they have the fastest correlation to market move of any of the classes, they also, when it's a bear market, go down fastest. Mm-hmm. So don't get excited and think, well, that's not true, or what you guys saying, it doesn't make sense, because recently the market's been doing well over the last year and a half or so, and these smaller stocks I've seen much bigger returns. It's just a period in time. It's not looking at the big picture. So I know some of you all, just gotten into the market recently, and you're listening to Leon and you're thinking that's not true. I had this small stock that returned 70%. I had this stock that returned 40%, 50%. Yes, in this period of time. But when COVID was hitting, I promise you, those stocks were being depreciated by like 80% of value in days. Mm-hmm. And so when we're talking about this, there are a lot of angles, and I know we don't go into every single aspect of the stocks during our these podcasts because we can't. But there are some things we just want you to walk away with while you take the bigger message about a recovering market, or a market that looks like it's prime for recovery.
Hey, sorry. Look, you want it? You good?
Yeah, I'm good. Go ahead.
Oh no, so I'll just to touch on Brent's point. So there's a way to measure small cap stocks. It's the ETF is IWM. It measures small cap stocks, right? And through this year to date, small cap stocks right now are down 2%. The S&P 500 is up, let's say 16%, right? So again, like Brent said, and so for whatever reason, small cap stocks, well, there are a number of reasons, but the whole thing about recessions coming and the Fed and all that, as Brent said, small cap stocks, when they move, they move. So if we're in a raging bull market, them things fly through the roof. In a market like this, where there's all these different headwinds the market is facing, they don't do so well. And that's the kind of market right now with the Fed, with the war, with all types of uncertainty. Yeah, it's only right. Exactly. That's the word. There's uncertainty in the market right now. So small cap stocks have not done well. Again, they're down about 2% for the year. Now that's an aggregate. You may, like Brent said, you may have some individual small cap stocks that are doing well, which is great. But generally speaking, and generally speaking for this year and throughout history, small cap stocks do bad, really, really bad in uncertain markets, as Brent said, which we're in right now. And again, the S&P 500, which is the biggest, baddest of them all in the U.S., is up 17%. So that kind of shows you that, and that kind of speaks back to that report, that the study I referenced earlier, that's inside the membership community, where large cap stocks have outperformed small caps in every other asset class, bonds, commodities, and small cap stocks over the last 20 years because of their stability. They have cash flows, they have growing earnings. Like Berkshire Hathaway, large cap financial, has $147 billion in the bank. $147 billion in the bank, like sitting there earning, I don't know, 3 to 5% per month, per year on that type of money through these treasury bonds. So stability is what people are looking for right now in these markets. And that's why small caps right now probably aren't the best play. Large caps most likely are.
All right, everybody, we thank you again for being with us. We hope we explained it in a way that you can actually digest it and go do something with the information. But if you're still like, you know what, I know there are pieces that I just don't understand, please, a great time to join Investing Education Academy. We're happy to provide this education to anyone who wants to receive it. And also for those of you all who are thinking, you know what, I would love to invest with you guys. We do have the IEA Portfolio Panthers. We're doing some pretty incredible stuff right now and experiencing a lot of growth. But at the same time, it's a place where you can come invest and be with other investors, so you're not exposed, for lack of a better way. And then also, so you have a community around you to not only learn with, but to invest with. So if you're interested, contact Leon or myself. If you want to become a member, you can go to IEAnow.com, choose a membership plan that works for you. Our memberships, we've made it so it makes sense for almost anybody. We have plans that start at like $18 a month, and then we have plans that are $5,000 a year. So it just depends on what you want to do with your financial knowledge or how you want to position yourself within the Investing Education Academy ecosystem. Everybody, thank you, and we look forward to seeing you.
Yep. Remember, two things. So we first we owe you two stock picks, and or crypto, depending. Right now, crypto's a little weak, but we owe you 2 picks. We'll post that in the community tomorrow. But also want to highlight for those who are watching the podcast, you notice at the bottom right, there's a QR code. And that QR code is a way now for anyone, as Brent said, if you're interested, great. You can go to IAMembers.com to join. But if you click on the QR code, that'll it's basically a feedback form or an interest form that you can fill out. It's it's less than five.
It'll take you probably 45 seconds.
Yeah, 45 seconds to fill it out. So if you're interested in IA without actually joining immediately, just scan that QR code, fill out that 5-question form, and then we'll we'll reach out to you and kind of explain IA a little deeper. But that QR code is new, and definitely scan that if you have interest.
Thanks, Dan. I totally forgot about that. So everybody, we are improving. We're trying to bring better systems, and this is a road to watching us improve along the way. And we look forward to seeing how you all use it actually, because it helps us understand where the information or what type of information you want to hear more about. So that's a really important code to scan, just like Leon said. Again, have a great day, and we will see you all in 2 weeks. And if you want the stock picks, you have to be a member. So that is a member privilege. We'll talk to you all later.